this series of videos is going to be an experiment to do something that I'm calling it's a long call strategy for call options for Canadian stocks. So I'll just explain what I'm doing. And the reason why I'm trying this is because first I did a simulation and I made $600 in 4 days. So then I decided to use my real money. So I don't know what's gonna happen. I could end up losing all my money. That's why I'm making these videos, because I don't know what's gonna happen and nobody knows what's gonna happen. So these are the 15 stocks that I bought, and so far it's been 3 days. So it's been 3 days, and my strategy, I've sort of changed everything. So originally my criteria for the stocks is that it has positive 1-year growth, 5-year growth, and all-time growth. And I realized the problem is that even if the stock has good long-term growth, doesn't mean it has good short-term growth. So I might lose money on some of my stocks, some of my call options. Again, I don't know what's gonna happen, but anyways, all the call options I bought, they expire on November 17th. So I still have more than 30 days to sell all of them for a profit. And given how volatile the call options are, I think there's a very high probability that I won't lose my money. So on top of that, for the stock criteria, I also have the call option criteria. Basically, for example, for CNQ, if I look at the 1 month spread, then the 1 month low is $82 and the 1 month high is $89, which means so if I look at the November 17 call options for CNQ, then so it's from 82 to 89, so there is a 7-point spread. That means that if I buy at, for example, 70 cents, then it should rise at least 6 points. So 70 cents, there's a high chance that it'll turn to $2.26. So that's that's the basic idea of the long call strategy, is that I buy a call option, a cheap call option that is out of the money, and then it will, ideally it will be in the money, but but it doesn't have to be in the money. It just has to be close to being at the money, and the price will be many times higher. So that is the idea. So so I buy the options. So the call options, I buy them for a price of around $1. So then my minimum loss per contract is $100 plus $11 commission. So the risk is relatively low, and I'm holding 15 call options for 15 different stocks. So I am fully diversified. 15 is very diversified. I think 20 would be optimal, but I don't want to put that much money in. So the theory is like this. Basically, I buy the option at a price of less than $1, and then I sell it for a price of over $2. because of how volatile, as you can see the price is the price of the call option is very volatile. If the price of the underlying stock changes, so there's a very high probability that the call option will be worth at least $2. There's also a possibly significant probability that the call option could be worthless on November 17th, which is why I'm making these videos, because so that everybody, not just me, can see exactly what happens. So all these expire on November 17th, and hopefully I can sell all of them by November 17th for a profit. So far CNQ rose in value, and then all the other ones dropped in value, so I'm a little bit worried, but it's only been 3 days, and there's over a month, so I don't see a problem, because I think all of these are growth stocks. So I think in the long term they will all rise in value. So the only question is, will they rise in value within the next month? So anyways, I've slightly updated the stock criteria, because again, I realized just because a stock has positive 1 year, 5 year, and all-time growth doesn't mean that it has good growth, in the 1 month time frame, which is why I created a different criteria. So for this one, I list the 1 day, 5 day, 1 month, 6 month, 1 year, 5 year, and all-time return. And for each of these, if the return is positive, then it gets 1 point. So for example, CNQ has 6 points, because it has 1, 2, 3, 4, 5, 6 positive return time periods, and then only 1 negative return time period. So I tried to consider every stock in the TSX, but obviously there's way too many, but I considered a lot of them. And so there's a couple that I'm holding right now that are really bad. So DSG, POW, TFII, BAM, CPL, NA, and QSR. So I'm holding these. In the long term, they have positive return, but in the short term, I think they're dropping. So there's a likelihood that these could expire worthless, in which case I would lose not too much money, but I would lose a significant amount of money. So I didn't think about this when I bought the stocks. I only realized this afterwards. But if I were to sell these, then I wouldn't buy these back. I would buy AGI or CGI, one of the ones with a higher growth score. So that is that, and I'll just show you. So I am holding all 15 of these, and right now they are all worth less than I bought them for, except for CNQ. And obviously some of the value comes from the commission, and some of it comes from the fact that I bought for a limit price rather than market price, so I bid slightly too high. So anyways, I don't know what's gonna happen, but I'm gonna be optimistic about this, because in my simulation I did really, really well. So I think part of this might have to do with I don't know, maybe it has to do with the economy, maybe the stock market is going into a bear market, in which case all these stocks will drop in value, and then I'm gonna lose money. Not a lot of money, but I will lose, money. But anyway, so yeah, I have them all at sell, so I bought all of them for around $1 or less than $1, and then I plan to sell them for double that. So I'm selling them for like $2. So then I would make $100, and then minus commission, so about $75, $80 per call option. And so I apologize. The recorder is a bit laggy because I'm on a Chromebook, so it's not very good. But anyway, so I found some other stocks that have a growth score of 5 or higher, and I'm using the built-in screen recorder for Chromebook because it seems to be the best. And so anyways, this is the theory. So I try to buy stocks where I look at the 5-day graph. So the 5-day graph. So then, for example, for CNQ, then the spread is all the way from 82 up to 91. So there's a 9-point spread. So obviously the call option is very volatile because a 9-point spread in 5 days gives, and the underlying stock gives a, so if I buy at 70 cents and it rises $8, then I can sell it back for $3. So it'll more than triple in value over 5 days. So that is my hope. So my strategy, I buy at $1, sell at $2, and then there's about $20-$25 commission in total for buying and selling, and then I'm holding 15 different stocks. So ideally, this is what would happen if every 5 days I make $75 off of each call option, then I would make $6,000 a month. I don't think this is gonna happen. I hope it's gonna happen. But anyway, so what needs to happen for this to happen is that the stock price has to rise enough so that the call option doubles in price. And then so this is for my growth score. So obviously if the stock rose in value in the past 5 days, 1 month, 6 months, 1 year, 5 year, and all time, then it has 7. It has a growth score of 7. So assuming it rose in the past, then it's very likely to rise in the future. So that is my theory. And then so obviously if the stock price rises $1, it's not necessary, the option price doesn't really rise $1. Let's see, so if the stock price rises $2 and the option price rises 30 cents. So it's not that much, but obviously the closer it gets to being in the money, then the higher this is. So maybe I should have bought closer to being at the money. Obviously they're more expensive, but they also have a higher correlation with with the underlying stock, which I believe is called the delta. So a higher delta means, a higher correlation between the stock price change and the call option price change. So this, I don't think this is a very simple model, but I could say if depending on how many times the price rose in the past, then that gives a probability that the price will rise the next day. So if I look at the past 10 days, in 7 of the 10 days the price rose, so there should be a 70% chance that that the price of the stock will rise tomorrow. Maybe. Again, all of this is not very precise. So anyways, there's a lot of other things that, and I apologize if there's any background noise because I'm recording in a public area, and there is a daycare next door, so I apologize for any background noise. But anyway, so the idea is that, first of all, I did the simulation and made a lot of money, so now I want to try it in real life. Problem is, in the simulation I didn't take into account the commissions, but I don't think the commissions are significant enough that I won't make money. So anyways, I explained all this, but obviously the stocks are sensitive to the TSX index. So if the TSX index falls, then on average my stocks will also fall, because I have very diversified stocks, so they are kind of representative of the TSX index. And then for the past 2 days the TSX index has fallen, so then most of my stocks also fell, and then that means that the call options also fell. But if the TSX index rises, then the opposite will happen, and hopefully the call options will rise in price enough that I can sell them off for a profit. But there's a different way of thinking about this, and that is to say, first of all, would I want to buy these 15 stocks and hold them for 1 month and sell them afterwards for a profit? If yes, then I would also want to buy the call option, because the call option is actually better than the stock, because if the stock rises $1, then the call option doesn't rise just so if the stock rises 1%, then the call option might rise, depending on how high delta is. The call option could rise, 10%, 20%, 30%, 50% in value. So the call option is much more volatile than the stock, so obviously it has a much higher return. And then on the flip side, the risk is also lower, because let's say that the stock is worth $100, and so if I own the stock, then potentially I could lose $100 if the stock price goes to 0. But if I own the call option, then at most I lose $1, or however much I paid for the call option, which is $1 per share. I'm talking about per share, so per share I only lose $1 instead of $100. So the return is leveraged over the stock. The return of the call option is leveraged over the stock, so it has a better return. And then the risk is hedged. versus the stock. The stock can lose its entire value, but the call option can only lose as much as I paid for it, which is much less than the actual stock. But obviously there's one other possibility, and that possibility is that I could own the call option for let's say 30 days, and then the call option expires, and it's worth $0. So, but then after the 30 days, the stock rises in price. So in that case, if I own the stock, I would make money, but if I own the call option, then I lose money. But this isn't necessarily true, because after the call option expires, I can buy it again, and then if the stock rises, then the call option also rises, and then I'll make that money back. So anyways, my theory is that any time that there is a stock that I want to buy and hold and sell within a given time period, then if I buy the call option instead, then it has a much higher leveraged return and a much lower hedged risk. So that is my theory. And then I thought of some possible drawbacks to my strategy. So the first one is, what if the Canadian economy is doing badly? What if the stock market crashes? What if the economy goes into a recession? And my argument is like this. So even if the TSX index on average is falling, there will be some companies, some stocks that are doing well. For example, CNQ is doing well, so it has a positive 1 day, 5 day, 1 month, 6 month, 1 year, and 5 year return. So it's very likely to keep rising. The stock price is very likely to keep rising. And so there are many stocks like CNQ. There's at least 15. I think my mistake was that when I bought the stocks, I didn't use this growth score criteria to buy the stocks. I just looked at the long-term growth. But then I forgot that I'm not doing a long-term investment. I'm doing sort of like a short-term buy, hold, and then flip. So that was my mistake. But obviously there's nothing I can do about that right now because I already bought them. But in the future, if I can sell off the bad call options, then I'll buy different call options. Okay, so then the second possible objection is, why would someone be willing to sell me a call option that is worth $1 today if it's going to be worth $2 tomorrow? You know, if the fair price of the call option is actually $2, then why would the seller sell the call option to me for $1? And my answer to this is really simple. So let's say that someone sells me a stock today for $90, even though I sell the stock tomorrow for $91. So then why would someone be willing to sell me a stock for $90 even if it's worth $91 tomorrow? Well, the thing is, the stock is worth $90 today, so if the seller tried to sell the stock for $91 today, nobody will buy it. Okay, so for the same reason, it is possible that a call option is worth $2 tomorrow, but if the seller tried to sell the call option for $2 today, nobody will buy it because today it's only worth $1. So the reason why the $90 to $91 looks much less dramatic than the $1 to $2 is because a stock has a much lower volatility than a call option. A call option is very volatile. So it's very likely that a call option can be worth $1 today and then $2 tomorrow. But obviously it's not, it's basically impossible for a stock to be worth $90 today and then $180 tomorrow. So this is the reason why I'm choosing to invest in call options instead of stock shares, because the possible return is significantly higher. It's 10, 20, 30, maybe 50 times higher. So that is about it. So this is my first recording, so I don't want to say too much, but I think I've managed to cover everything. So I'm going to end this recording now, and I don't know if I can make a video every day or every week. It sort of just depends on if I can find a quiet enough place to record. That is the main thing, but I definitely want to make this into a series, because I think this is going to be very interesting. I don't know how it's going to turn out. I could lose some money, or I could make a lot of money, and I think as I keep going, I'm going to keep adjusting my strategy, because obviously this is a learning process, and I've already adjusted my strategy a lot. So yeah, so hopefully everything will go well. Bye bye for now.